The global money supply is shrinking for the first time since 1949, and a 90% recession risk is now officially baked into the cake.
Johns Hopkins professor Steve Hanke and former Fed trader Joseph Wang are sounding the alarm on a massive liquidity drain that is rattling the very plumbing of our financial system.
We have distilled hours of macro analysis from experts like Jeff Snider and Nick Gurley into this fast-paced briefing to save you time and protect your capital.
Stay tuned to find out why a 40% surge in cheap homes is hitting the market and which triple threat could send oil prices and your portfolio into a tailspin.
Joseph Wang is sounding the alarm that the Fed's liquidity drain is reaching a breaking point, with reserves potentially hitting a danger zone of $2.5 trillion.
Exactly. As a former Fed trader, Joseph knows the plumbing better than anyone, and he's seeing the buffer in the reverse repo facility vanish.
Hold on. Plumbing? Are we talking about the economy's pipes or something?
In a way, yes. It's how money moves between banks, and Joseph says the pipes are starting to rattle.
And while the reserves are the main story, the real disaster is brewing in the private repo market, which we will hit in a second. Joseph Wang's core thesis is that the Federal Reserve is pulling $95 billion out of the system every single month through quantitative tightening.
Right, and he points out that they aren't just slowing down, they are effectively shrinking the money supply while the government keeps borrowing.
Wait, $95 billion a month? That sounds like a lot of money to just disappear.
It is. Joseph argues that this disappearing act is going to force a spike in interest rates that the Fed can't control.
It's like trying to drain a pool while 3 other people are trying to fill it with fire hoses. It's chaotic.
So we're basically waiting for the pool to go dry? Great.
According to Joseph Wang, the reverse repo facility, or RRP, has plummeted from a peak of $2 trillion down to just $200 billion.
That's a 90% drop. Joseph notes that this was the spare liquidity in the system, and it's almost gone.
Okay, $200 billion still sounds like a massive number to me. Why is that a problem?
Because when that hits zero, easy money to soak up the treasury bills the government is printing.
Exactly. Once it's gone, the Fed has to decide between stopping QT or letting the repo market break.
So it's the financial equivalent of a low battery warning.
Joseph is also tracking the SOFR rate, which has started spiking 15 basis points above the Fed's target range during month ends.
That's a huge red flag. It means banks are getting desperate for cash, even for just 24 hours.
Wait, basis points? Can we speak English for a second?
Fair point. Basically, the cost for banks to borrow from each other is getting more expensive and more unpredictable.
And Joseph thinks this volatility is the first sign that the Fed's control over interest rates is slipping.
So the Fed is losing the steering wheel. That's comforting.
The other half of Joseph's analysis focuses on the supply side. The government is issuing $1.6 trillion in new debt this year.
And with the Fed not buying anymore, someone else has to step up. But Joseph says the buyers are exhausted.
1.6 trillion. Who even has that kind of money sitting around?
That's the problem. Private investors and banks have to buy it, but they are already tapped out.
Joseph warns that if there aren't enough buyers, the price of these bonds drops and interest rates skyrocket.
So we're throwing a party with way too many guests and not enough pizza.
Joseph Wang predicts that the Fed will be forced to completely end quantitative tightening by June of 2026.
He believes the pressure in the repo market will be so high that they won't have a choice if they want to avoid a market crash.
Wait, so they'll just stop draining the money? Does that mean the low battery gets plugged in?
In theory, yes. Stopping QT means they stop pulling cash out, which should stabilize things.
But Joseph warns it might be too little too late if they wait for something to actually break first.
Great, so we're waiting for the smoke before we call the fire department.
Before that pivot, Joseph expects a massive spike in repo rates, potentially 50 basis points above the target.
That would be a repeat of the September 2019 crisis, where the plumbing literally clogged up.
50 basis points sounds small, but in bankland, I'm guessing that's a heart attack.
It's a massive jump. It makes every loan and every trade more expensive, instantly.
Joseph's data suggests the risk of this happening is highest in the next 6 to 9 months.
Note to self, don't look at my 401k in 6 months.
Joseph suggests keeping a hawk-like eye on the SOFR rate and the RRP balances every week.
If the RRP drops below 100 billion, Joseph says that is your final warning before volatility hits.
So if I see that number get small, I should start worrying about my stocks.
Basically, liquidity is the tide that lifts all boats, and Joseph says the tide is going out.
Joseph also notes that staying in short-term treasuries might be the safest bet until the Fed pivots.
Right? You get the yield without the risk of getting caught in a long-term bond crash when rates spike.
So, keep my cash where I can reach it and wait for the Fed to blink.
Exactly. That's the Joseph Wang playbook for 2026.
Stay liquid, stay alert, and don't trust the pipes.
Got it. I'll just be over here watching the RRP like a hawk.
The markets are waking up to a mess today. Matt deWolf from Trade Brigade is tracking an overnight panic that sent indices gapping down while oil is absolutely ripping.
It is a classic risk-off setup. Matt's seeing oil prices hit new highs, which is basically throwing a wrench into any hopes for a quiet trading session.
Wait, if oil goes up and stocks go down, does that mean my gas prices and my 401k are both taking a hit at the same time?
Precisely. It's a double whammy for the average consumer, and Matt notes the technical levels are looking shaky.
And while oil is the star of the show now, Matt's data suggests a massive trap in the tech sector we'll look at in a minute. Matt deWolf's core thesis is that as long as oil is ripping to new highs, the broader market can't find its footing.
Right, because high energy costs act like a tax on every other sector. Matt's watching for a sustained breakout above key resistance levels.
So oil is basically the bully on the playground right now, pushing everyone else around.
Exactly. And Matt points out that the overnight panic selling shows just how nervous traders are about this spike.
It's not just a small move. We're talking about a significant gap down that changes the technical landscape. Let's look at the charts. Matt deWolf highlights that the S&P 500 has gapped down below key support levels from yesterday.
That's a huge red flag. When you gap down like that, the previous floor usually becomes the new ceiling.
Hold on. A gap down? Is that like when a stock opens way lower than it closed the day before?
Spot on. It means there was so much selling pressure overnight that the price just skipped over a whole range.
And Matt's warning that if we don't reclaim those levels early, things could get even uglier by noon.
So, we're looking for a recovery, or we're just sliding down the hill.
Matt notes that with oil hitting $90 per barrel, the cost of production for almost everything is going up.
That's why we're seeing the overnight panic. The market is pricing in higher inflation for longer.
Wait, $90? I remember when it was way lower. Is that a record?
Not a record, but it's a significant multi-month high that Matt says is triggering algorithmic selling in stocks.
Basically, the machines see high oil, and they start dumping tech and retail stocks automatically.
Great, so the robots are panicking too. That's comforting.
The VIX, or the fear gauge, is up 15% this morning, according to Matt's analysis.
That 15% spike tells us that traders are frantically buying protection against a further drop.
15%? That sounds like a lot of people are suddenly very worried.
It is. Matt uses the VIX to gauge sentiment, and right now it's screaming caution.
When the VIX spikes that fast, Matt looks for an extreme reading to signal a potential short-term bounce, but we're not there yet.
So we're in the worrying phase, not the it's so bad it's good phase.
Matt deWolf is predicting a gap and go scenario where the market keeps sliding after the opening bell.
His reasoning is simple. If there aren't enough buyers to step in during the first 30 minutes, the selling usually intensifies.
The first 30 minutes? That's it? The whole day is decided that fast?
Often, yes. Matt calls it the opening range. It sets the tone for the institutional traders.
If we stay below the opening range, Matt's targeting another 2% drop by the close.
I think I'll just close my eyes for those 30 minutes.
On the energy side, Matt predicts oil could reach $95 per barrel if it holds its current momentum.
That would be a massive headwind for the airlines and shipping companies.
So more expensive flights and more expensive shipping for my online orders.
Exactly. Matt's basing this on the break of the previous high, which has now turned into a launch pad.
If oil hits 95, Matt expects the Nasdaq to see even more pressure as investors flee to defensive sectors. Matt deWolf's top advice: watch that opening 30-minute range like a hawk.
If we break above it, the gap might fill. If we break below, get out of the way.
So the opening range is like the scoreboard at halftime.
More like the first quarter, but it tells you who's got the momentum.
Also, keep an eye on oil prices. Matt says they are the lead indicator for this specific panic.
If oil starts to cool off, the pressure on stocks might ease up.
So if I see oil dropping, I can breathe a sigh of relief for my tech stocks.
According to Matt's analysis, that's exactly the correlation to watch.
Got it. Staring at oil charts and the clock for 30 minutes. Busy morning.
We're breaking down a pretty dire warning from Steve Hanke, a professor of applied economics at Johns Hopkins, who's known for his focus on money supply.
Exactly. Hanke has been tracking economic cycles for decades, and he's telling David Lynn that we are entering territory we haven't seen in over 70 years.
70 years? Wait, so since the 1950s? That's older than my parents.
Exactly. His data suggests the everything bubble is about to hit a massive wall because of something called M2.
Steve Hanke's whole argument revolves around the quantity theory of money. If you don't watch the money supply, you're flying blind.
And right now, Hanke says the money supply isn't just slowing down, it's actually shrinking, which is a massive red flag for the markets.
Wait, what is M2? Is that like a secret spy agency or something?
Think of it as the total amount of cash, checking deposits, and near money floating in the economy. It's the fuel for the engine.
And according to Steve, that fuel tank is draining faster than people realize.
The core of Steve Hanke's thesis is that the M2 money supply has contracted by 4.5%. This is the first time this has happened since 1949.
It's a complete reversal from the 27% growth we saw during the pandemic stimulus era.
Hold on, 4.5% sounds small. Is that really a big deal?
In economic terms, it's huge. We went from a massive sugar high of cash to a sudden drought. Hanke says this always leads to a reckoning.
It's like the Fed slammed the brakes while we were going 100 miles per hour.
So we're all about to fly through the windshield. Great.
Hanke explains to David Lin that there is a significant lag between when the money supply changes and when we actually feel it.
Specifically, a 6 to 18-month lag. That's why inflation didn't disappear the second the Fed started tightening.
So it's like a delayed reaction, like when I eat spicy food and don't regret it until the next morning.
Exactly. We are currently living through the regret phase of the money supply shrinking from late 2022.
And Steve warns that the full impact of this contraction hasn't even hit the labor market or corporate earnings yet.
So the worst is still coming. I need to sit down.
Steve Hanke describes the current market state as a sugar high from that 27% spike in money growth during the lockdowns.
That excess money is what pushed asset prices to record highs, but that liquidity is being drained out of the system right now.
Is that why everything feels so expensive, but the stock market keeps going up?
Exactly, but Hanke says you can't defy gravity forever. Once that excess cash is gone, the floor drops out.
The Fed is ignoring these numbers, but the data doesn't lie. When the cash goes, the crash follows.
Note to self, avoid floors that are about to drop out.
One of Hanke's biggest gripes in the interview is that the Federal Reserve doesn't even look at M2 anymore.
He calls it monetary illiteracy. They focus on interest rates, but ignore the actual volume of money in the system.
Wait, the people in charge of the money don't look at how much money there is. How is that possible?
They think interest rates are the only lever that matters. Steve thinks that's a recipe for a policy disaster.
He argues that they caused the inflation by printing too much, and now they'll cause a depression by draining too much.
It sounds like they're trying to fix a flood by creating a drought.
Steve Hanke isn't sugarcoating it. He puts the probability of a recession at 90% based on these M2 trends.
He tells David Lin that it's baked into the cake. You can't have a money contraction this sharp without a major economic slowdown.
90%. Those are like, I'm definitely going to regret this odds.
It's essentially a certainty in his model. He expects unemployment to start ticking up as the lag finally catches up to us.
And when that happens, those corporate earnings that look so good right now, they're going to evaporate.
So the sugar high ends in a massive stomachache. Got it.
Regarding the S&P 500, Hanke suggests that the market is currently priced for perfection in an imperfect world.
He predicts a significant correction. When the recession hits and earnings drop, the current valuations won't make any sense.
So my 401k is basically a balloon, and Steve is holding a needle.
More like the air is already leaking out. We just haven't noticed the balloon shrinking yet.
He's warning that investors are way too complacent right now, ignoring the most basic rule of economics. Follow the money.
I think I'll follow the money right into a safe under my bed.
Hanke's biggest advice? Watch the M2 money supply data like a hawk. It's released monthly by the Fed.
If you see M2 start to grow at a healthy 5 or 6% again, the danger might pass. But until then, stay cautious.
So if the M2 number goes up, we're good. If it stays down, we're in trouble.
That's the basic signal. Right now, it's still deep in the danger zone. Given the 90% recession risk, Steve suggests being very careful with high-risk assets right now.
Cash might actually be king for a while, providing a buffer when the volatility finally hits the fan.
Wait, so boring old cash is actually the smart move?
According to Hanke's analysis of the money supply, yes. Better to have dry powder than to be caught in the fire.
It's all about surviving the correction so you can buy the bottom later.
Alright, I'm putting my piggy bank on high alert.
We are diving into some shocking new data from Nick Gurley, who is highlighting a massive shift in the housing market based on the latest Realtor.com reports.
Nick's analysis shows that homes priced under $350,000 have seen a 40% jump in listings compared to last year.
Wait, 40%? I thought the housing market was frozen and nobody was selling.
That is exactly what makes this data so wild. The starter home segment is finally seeing a flood of inventory.
So the drought might be over, but Nick warns that this isn't happening everywhere equally.
Okay, so there is a catch. There's always a catch with these good news stories.
Nick Gurley's core thesis is that the supply of affordable homes is hitting the market at a rate we haven't seen in years.
He notes that this 40% increase in cheap inventory is a clear signal that the lock-in effect is starting to crack.
Hold on. What's the lock-in effect again? Is that the thing where people won't sell because their mortgage rate is like 2%?
Precisely. But Nick says sellers are finally losing their patience or simply forced to move for life reasons.
And while inventory is up 40%, it's actually even higher in certain regions, which we will get into.
So if you're in the right spot, you might actually have options for once. Imagine that.
Nick Gurley points out that the South is basically the epicenter of this inventory explosion.
In states like Florida and Texas, some cities are seeing inventory levels rise over 50 or even 60% year over year.
Wait, 60%? That's not just a surge, that's a tsunami of houses.
Nick attributes this to massive overbuilding and investors finally deciding to cash out as the market cools.
So if you're looking for a cheap house in the Sunbelt, you're finally in the driver's seat.
Unless you're the one trying to sell there. Then, you're probably sweating through your shirt.
A big part of Nick's analysis focuses on the role of institutional and mom-and-pop investors.
He believes many of these cheap homes hitting the market are former rentals being dumped by investors who see the writing on the wall.
So the landlords are bailing. That sounds like a big deal for rental prices too.
It is. Nick mentions that as inventory rises, the pressure on both sale prices and rents increases.
It's a complete reversal of the bidding wars we saw in 2021.
Good. My heart can't take any more highest and best offer deadlines.
Nick Gurley highlights that national inventory is finally crawling back toward 2019 levels.
While we aren't all the way back to normal yet, the trend line is very aggressive, especially in that sub-$350,000 price point.
So, normal means I can actually ask a seller to fix a leaky faucet without them laughing at me?
Exactly. Concessions are coming back. Nick notes that more sellers are now paying for buyers' closing costs.
The power dynamic is shifting from take it or leave it to please take it.
I like the sound of please take it way more.
What does Nick Gurley predict for prices as this inventory keeps piling up?
He's very clear. Price cuts are the next logical step. We're already seeing a record percentage of listings with price reductions in the South.
Wait, a record percentage? Like how many sellers are actually slashing prices?
In some markets, over 30% of active listings have already seen a price drop, according to Nick's data.
And that is just the beginning. More supply always leads to lower prices eventually.
So if I wait 6 months, that house might be even cheaper.
Nick believes we are heading toward a broad buyer's market by the end of 2024.
The combination of high interest rates and exploding inventory means buyers will finally have the leverage to negotiate.
Leverage? Is that the thing where I can offer less than the asking price?
Yes, exactly. No more bidding 20% over asking just to get an inspection.
Nick warns, however, that the Northeast and Midwest might still remain tight for a while longer.
Of course. My luck, I live in the one place where it's still a bidding war.
Nick Gurley suggests that the most important metric for you to watch is active listings in your specific zip code.
If that number is rising month over month, you have the upper hand. Don't let a realtor tell you otherwise.
So I should check realtor.com like it's my social media feed.
Basically, Nick says data is your best weapon against high prices.
Knowledge is power, especially when the market is turning this fast.
Another tip from Nick's analysis is to target homes that have been sitting for 60 days or more.
60 days? Why 60? Does the seller just give up at that point?
At 60 days, the seller usually starts to panic, which makes them much more open to lower offers.
That's when you swoop in with a realistic offer, not a hope and a prayer bid.
Got it. Patience and data. Sounds like a plan to me.
Exactly. Thanks for following Nick Gurley's insights with us today. Today we are dissecting a brutal forecast from Jeff Snider of Eurodollar University. He is warning that a triple threat of oil shocks, job losses, and a credit crisis is hitting all at once.
Jeff argues that this isn't just a soft patch. When you combine high energy costs with a weakening labor market, the economy loses its ability to absorb any more shocks.
Wait. Triple threat. That sounds like a bad action movie. Is it really that dire, or is Jeff Snider just being a permabear?
It's the data, not just a mood. Jeff points to historical cycles where this exact combo led to major downturns.
Here is the alpha. Jeff Snider notes that oil spikes usually do not kill an economy that is strong, but when the job market is already cracking, it is game over.
Exactly. It's the ultimate open loop for our discussion. We will see how these energy prices are the final straw. But first, we have to look at the silent killer, the credit freeze.
Hold on. If oil is the final straw, what is the actual bale of hay? The jobs or the banks?
It's both. Jeff's analysis shows the credit market is actually the foundation that is crumbling underneath them.
Jeff Snider's big idea is that we are moving past lower inflation and straight into a deflationary bust.
Right? He believes the market is misinterpreting the data. While the Fed is looking at lagging indicators, Jeff is looking at the plumbing of the global financial system.
Deflation? I thought we were all worried about things being too expensive. Why would prices going down be a bad thing for my grocery bill?
Because in Jeff's world, prices drop because nobody has money to spend. It means jobs are disappearing.
Exactly. If companies can't sell their products, they cut staff. That is the cycle Jeff is tracking right now.
Okay, so cheaper eggs aren't worth it if I don't have a paycheck. I get it.
Jeff points out that even a 15% rise in oil acts like a massive tax on the middle class.
And it's worse because it's non-discretionary. You have to drive to work, you have to heat your home.
So basically, I'm paying more for gas, which means I'm spending less at the mall.
Exactly. And Jeff Snider argues this tax hits right as companies are already starting to trim their payrolls.
It's a double whammy. You're earning less or fearing for your job while your basic survival costs are spiking.
That sounds like a recipe for a very depressing holiday season.
Jeff Snider is highlighting a scary trend, the loss of over 1 million full-time jobs while part-time work spikes.
That is a huge red flag. It's the classic underemployment trap that precedes a real recession.
Wait, 1 million? The news said the job market was resilient yesterday.
Jeff says the headline numbers are a lie because they count 2 part-time jobs as 2 new jobs, even if 1 full-time career was lost.
So the quality of employment is cratering. People are working more for less security.
So it's like trading a steak for 2 packs of gum and calling it a gain in food items.
Finally, Jeff Snider looks at the credit market. According to the SLOOS data, 40% of banks are tightening lending standards.
If you can't get a loan, you can't grow a business. It's the blood supply of the economy being cut off.
40%. Does that mean I'm going to have a harder time getting a car loan or a mortgage?
Precisely. But more importantly, it means small businesses can't bridge the gap during the oil shock we talked about.
Jeff emphasizes that this credit contraction is what turns a slowdown into a crisis.
So no money, no jobs, and expensive gas. I'm starting to see why Jeff Snider is so worried.
Jeff Snider predicts that if this credit freeze continues, we are looking at a 2 to 3% contraction in GDP.
And that would bring the unemployment rate up much faster than the Fed currently expects.
2% doesn't sound like much. Is that really a crisis level?
In a $25 trillion economy, 2% is $500 billion vanishing. It's massive.
It's the difference between a vibrant city and one with boarded-up windows.
Okay, put that way, 500 billion is a lot of boarded-up windows.
Jeff also predicts that interest rates are going to come screaming down, regardless of what the Fed wants.
Because the market will force them. When the recession hits, everybody runs to the safety of government bonds.
So wait, lower rates? Isn't that what everyone has been wishing for?
Be careful what you wish for. Jeff Snider says rates fall when things are breaking, not because we won the war on inflation.
It's a panic buy into bonds. That's never a sign of a healthy economy.
Got it. High rates hurt, but plummeting rates mean we're in the bunker.
Jeff Snider suggests keeping a hawk eye on the yield curve. If that inversion doesn't fix itself properly, the recession is locked in.
Specifically, watch the 2-year and 10-year spreads. When they start uninverting rapidly, that's usually the signal that the crash is starting.
Wait, uninverting? So when things look like they're going back to normal, that's when I should actually panic?
Exactly. Jeff Snider points out that the steepening is the actual indicator of the recession's arrival.
It's counterintuitive, but the data doesn't lie. Watch the bond market, not the news.
Note to self, learn to read bond charts, or start a vegetable garden. Maybe both.
Chris Vermeulen from the Technical Traders is sounding the alarm, and honestly, the charts look pretty ugly for anyone long on the S&P 500.
Chris is a technical analysis veteran who focuses on price action rather than the news headlines, and his data shows we are entering a major market shift.
Hold on. So he's ignoring the news. How do you even trade without looking at the headlines?
He believes the price action tells you everything before the news even breaks. It's all about identifying the stage of the market.
And right now, Chris says we're in the final stages of a massive topping pattern. The single biggest takeaway from Chris Vermeulen's analysis is that the stock market is in a stage 3 topping phase, which usually precedes a massive meltdown.
He's predicting a potential pullback of 30 to 50% once the breakdown is confirmed. While stocks are toast, he sees a huge rotation into gold and silver coming next.
Wait, 50%. My retirement account is basically half gone in that scenario. That's terrifying.
It is, but Chris argues that the technicals don't lie. We've seen this pattern in 2000 and 2008.
Exactly. The big money is already moving toward the exits, and retail is usually the last to know.
So we're looking at a cliff, and everyone is still dancing on the edge.
Chris Vermeulen notes that while the indices look okay on the surface, the technical exhaustion in big tech is undeniable.
Right, the S&P 500 is basically flatlining, while fewer and fewer stocks are actually making new highs.
So it's like a building that looks fine from the outside, but the foundation is totally rotting.
Great analogy. Chris calls this a breadth divergence. If only 5 stocks are carrying the whole market, that's not a healthy bull run.
And when those 5 giants stumble, there's nothing underneath to catch the fall. On the flip side, Chris is very bullish on gold. He sees it decoupling from the traditional stock market volatility.
He's looking at a 20% upside for gold as it breaks out of its multi-year base. It's the classic safe haven play when equities turn sour.
So while stocks go down 50%, gold goes up 20%. Why doesn't everyone just buy gold now?
Because most people are chasing the tech rally until it's too late. Chris's data suggests the smart money is already stacking bullion.
It's about timing the rotation, not just panic buying.
I'm starting to think I need a bigger safe for all this metal.
What about the miners? Chris mentioned the GDX looks like it's coiled for a move.
He's seeing massive accumulation in mining stocks. These companies are generating huge cash flow with gold at these prices, but their stocks haven't reflected it yet.
Wait, so the companies digging the gold are still cheap, even though the gold itself is expensive?
Exactly. There's a lag. Chris thinks the miners are about to play catch up in a big way.
That's usually where the biggest percentage gains are found during a commodity cycle.
Okay, so miners are like the high-octane version of gold.
How long does Chris Vermeulen think this meltdown will last?
He's predicting an equity bear market that could drag on for 12 to 18 months. It's not a flash crash, it's a slow grind down.
A year and a half of losing money. That sounds like a long time to be stressed about a portfolio.
It is, but if you're in cash or defensive assets like Chris suggests, you're actually gaining purchasing power while everyone else loses it.
So, the buy the dip crowd is going to get crushed if they jump in too early.
So patience isn't just a virtue, it's a survival strategy.
And his prediction for silver, I heard some big numbers.
Chris believes silver will eventually outperform gold. He's eyeing a target of $35 to $40 per ounce once the breakout confirms.
$40? Silver is way cheaper than gold right now. That's a massive move.
Silver is the restless metal. It sits still for years and then moves like a rocket. Chris says the technical fuse is lit.
It's all about that gold to silver ratio. When it breaks, silver flies.
I'm starting to think I need a bigger safe for all this metal.
So what's the game plan based on Chris Vermeulen's analysis?
First, protect your capital. He suggests moving to cash or very defensive assets until the stage 3 breakdown finishes its course.
So basically, stop trying to be a hero in a falling market.
Exactly. Wait for the charts to show a new stage 1 base before buying stocks again.
Chris also says to watch the 200-day moving average on the S&P 500.
If we break and stay below that line, the bear market is officially here. It's the line in the sand for institutional investors.
If the big banks are watching that line, I guess I should be too.
It's the simplest way to know if you're swimming with the tide or against it.
According to Chris, right now the tide is definitely going out.
And nobody wants to be caught without a swimsuit when the tide goes out.
Let's revisit what each of our brilliant guests argued. Chris Vermeulen warns us about the stage 3 topping phase, which he believes indicates that a major market correction is on the way.
Indeed, he describes it as a warning bell. Historically, it precedes significant declines.
So basically, he sees a storm cloud on the horizon and thinks we should all take cover.
Exactly, a storm warning that might catch many unaware.
Now moving on to Jeff Snider, who has a slightly different perspective.
Right, he argues that various crises, like liquidity drains, are merging to exacerbate economic fragility.
So it's not just one thing, but a perfect storm of economic woes.
Exactly, multiple factors compounding each other's effects.
And then we have Steve Hanke, who highlights an alarming trend.
His focus is squarely on the M2 money supply, which he describes as unprecedented.
Wait, so he's saying the money in circulation is literally drying up?
Yes, and this contraction could lead to dire economic consequences if not addressed.
Now here's where it gets interesting. All three of our guests see the current economic landscape as perilous.
They all concur that an urgent response is necessary to avert disaster.
So, despite their differing focuses, they're unified in saying we need to act fast.
Exactly. They highlight the gravity of the situation. Both Chris and Jeff are particularly alarmed about liquidity conditions.
Yes, they argue that increasing liquidity pressure threatens financial stability.
It sounds like they're on the same page about keeping an eye on liquidity.
Absolutely. It's the lifeblood of the financial system. Moreover, Steve and Jeff share a mutual concern regarding M2.
Right, they believe its contraction could yield severe repercussions for economic forecasting.
So basically, they're both saying that money flow is the key to predicting our economic fate.
Yes, and they highlight it as a critical factor moving forward. Now let's dive into some disagreements. Chris believes we're at a peak in the market.
Conversely, Jeff seems to suggest we may not fully realize how deep the downturn could be.
Wait, so one thinks we're at the top, and the other thinks we could be blind to worse drops.
Yes, the perspectives differ on the timing and scale of potential declines. On to the next point. Steve connects M2 contraction to historical precedents.
Chris is leaning more on immediate market indicators.
So, one is looking back for lessons, and the other is focused on signals in real time.
Exactly, showing that historical context versus present dynamics is a prevailing theme. Lastly, we see a clash between Jeff and Steve. Jeff's discussing systemic risks broadly,
while Steve zeroes in on the direct implications of monetary policy.
Wait, so Jeff's looking at the big picture, and Steve's hammering down on the specifics of the policies.
That's right, two lenses on how to understand economic threats. If you found this video insightful, don't forget to hit that like button and subscribe for more expert analyses.
We condense complex economic discussions so you can stay informed without the fluff.
Honestly, this was a time saver. I'm definitely hitting subscribe.
Thanks for tuning in, and catch us next time for more cutting-edge financial insights.